Good afternoon, I'm Hagan Rogers at Watermark Advisors, and today we want to present part 3 of our series of M&A in the economy and actually look back at history to analyze and determine what could history tell us about what may be right around the corner for the M&A markets, both for buyers and sellers. Our team has done a lot of research, and we're going to share with you what we believe may be near term ahead for all of us. So first, the fact is that two things have triggered where we are right now with very high inflation, and that is, one, a stunning increase in the money supply since Q1 2020. This is dramatic. This is the M1 money supply being injected into our economy. We've never seen anything like this. And M2, which was gradual, but also a steep increase since the pandemic. And secondly, $5 trillion in stimulus going out into the marketplace. Those two combined has created what we now have is high inflation, 8.6%. But if we look at inflation calculated as it was in the 70s, we would be in the high teens. So this inflation is super high. And so we studied two recessions, the 73-74 crisis and recession and the Great Recession of 2008 and 9, and we concluded that this, what we're facing, more closely resembles the early 1970s, and we want to share why. So to explain, back in the 1970s, three issues created the storm of that period. First, a very high level of deficit spending that was triggered by the Vietnam War. Secondly, we had the Saudi oil embargo of 1973. And thirdly, we had the collapse of the managed currency rates, which had been in place for decades. This recession only lasted 16 months. And however, in the 70s, we continued to be plagued by stagflation. You're hearing that word now, stagflation, and we think that is what we may be faced, low growth with high inflation. And so why do we resemble this period today of the 70s? We're faced with an energy crisis, very high energy prices. We're going to unpack that further in a second. We have deficit spending that's also very high and high inflation. So we're seeing similarities with the early 70s. And again, a takeaway here is that even if we get out of a recession in less than 20 months, the impact of that recession on the M&A markets can last for several years. So let's look next at how that plays out. And so if we go back to the 70s, in 1969, we had the peak of the M&A deal volume, 6,100 transactions closed here. We didn't see that level of volume again until 1989, so 20 whole years. And look how M&A volume dipped and never really recovered for 20 years as we had spiking inflation. So this is where we're faced today, and we can see that there's a lag time between when inflation comes down. So 1986, we really brought inflation down, but it took several years for M&A volume from that point to bounce back. So we think that this is very likely what we may be faced. And in that, volumes will retreat. However, we don't think they're going to retreat quite to the degree that they had in that period. I'll explain that in just a second. But we do think volume will retreat to some fraction, and there'll be a lag time from the recovery to where M&A volume and multiples get back to where we've been. 2021 and 20 were really a kind of a high watermark for the M&A marketplace. So again, what we have here is an energy dilemma, and we can see that very clearly in the increase in 12 months in the price of gas, dramatic increase, 62%, diesel up 74%. This affects consumer confidence. This affects the distribution and transportation industry, and this affects manufacturers. So you put all these together, and this is a serious problem that, if not resolved very quickly, is going to lead to a deepening of the overall downturn in the economy. So again, what we think is going to be different this time is that M&A has somewhat decoupled from the cyclical nature of the economy. Not 100%, but it will decouple. Why? Two reasons. One, there's tremendous levels of corporate cash on balance sheets now, as exemplified here. And secondly, we didn't have a private equity industry of any magnitude in the 1970s, where today, tremendous war chest of capital wanting to go to work and invest in great companies. So that alone, these two factors are going to keep M&A from tanking and crashing like they have in the past. We will see volume decline. We will see valuations decline. And so these are important considerations to make. So let's reach some conclusions for sellers. First, we think that the seller's market that we've been in now for perhaps 10 years is likely to be coming to an end. That window is shutting over the next 6 to 9 months. We're not going to see as favorable conditions for sellers as we have for quite a while. M&A transaction multiples are going to retreat for all but elite companies. Elite companies stand out because they have a great strategy, they have a great market positioning, great processes and people and financial results, culture, innovation, and momentum. Very hard to accomplish that, by the way. But again, like I just shared, expect a trough to peak for M&A values and volume to take several years to return to where we've been. And inflation is going to eat away at the purchase price considerations. What I mean by that is that if we sell a company for $10 million at the end of 2022, that is going to be much more money in the pocket of that business owner than selling a company for $10 million in 2025 or 26, because inflation is eating away at that purchase price. So sellers really should think, those that have been on the fence, business owners, about selling their company, long and hard about perhaps going ahead and acting now and trying to get in at the very end of this seller's market that we've been in. Good news for buyers, however. It's really shifting. The market is shifting to a buyer's market for the first time in many years. And as long as your core business is healthy as an acquirer, studies indicate that acquirers that move early in a recession and act in making acquisitions typically get greater outcome, meaning greater return on investment on their acquisitions, than those who are reluctant to acquire because they're not sure what's going to happen in the economy. There'll be less competition to a degree. We don't know how much, but definitely competition will retreat, which is great for those that are willing to take that action and acquire in this upcoming season. So that means really great opportunities to achieve a return on investment above a hurdle rate. So in conclusion, history repeats itself, and yet we're not going to see the same exact scenarios that we've had in the past. Sellers, consider the timing of perhaps moving and going ahead with a sell now before that window really closes for perhaps quite a while. For buyers, great opportunity is ahead, and start planning that and perhaps even acting early. Thank you for watching this video, and we look forward to sharing one more with you.